What's going on, guys? Today we're talking about a 3-2-1 buy down and how that works with VA home loans. And if you've never heard of what that is, don't worry about it. We're going to break down some of the pros, the cons, who pays for it, and is it a scam? We're going to cover all that in today's video. So just the basics of what a 3-2-1 buy down means essentially is that your interest rate is going to be lower for the initial 3 years. So this also applies to 2-1 buy downs, where the first 2 years you're going to have a lower interest rate before it gets to what's called a par interest rate. So let's break that down. And the first thing I'm going to focus on is going to be the 3-2-1 buy down itself. So what happens with this par rate, right? It's going to be dependent on what the rate is at that time. Now, some lenders do charge a premium to do these buy down interest rates, where they may charge you a little bit higher interest rate initially over the market rate. So just for educational purposes, just so I have something to work with in this video, let's just use 7% as an interest rate for the purposes of an example. So essentially what would happen is that the first year, the interest rate would be 3% lower than the 7%. So if it's going to be, let's say 4, 5, 6, 7, right? So 4% the first year. The second year, it's going to be 2% lower, so it's 5%. The third year, it's going to be 1% lower, so it's 6%. And then on that fourth year, it's going to be the market rate of 7%, which is going to be the par rate, right? Now, that doesn't include you paying any discount points for getting that, let's just say in this example, the 7% interest rate. So you really need to break down what that cost is of that interest rate compared to market rates, because I think lending institutions know that the person that's paying for it, they're paying it for it, and it's not you, that they can charge a little bit of a premium. That's my personal opinion on that. And then the other thing too, you have to always factor it in, like we say, is that if you're reaching out to a company because you're getting constantly marketed to, you're paying for that somehow throughout that. Now, there's definitely some pros and cons to this concept. And is it really competitive in today's market? Can you do it? Personally, to be honest, I have not done one in all of the time that I've been doing lending and thousands of transactions, just because there hasn't been situations that it's been able to do. But if you can do it, there definitely could be some pros to all of this. So obviously a big pro is that the initial payment's going to be lower. Now, very positive, but what you have to focus on is make sure that you're not expanding your budget on a monthly basis, because those payments are going to change over time. And a lot of times you do save a lot of money, especially if you're looking at like a $400,000 purchase price, which is the average across the country. Then when you have a 3% lower interest rate over what the market rate is, of course, that's going to have a big impact. And normally it's going to be like more than a couple hundred, like several $100s that you're going to be saving on a monthly basis. But that payment continues to go up, and you don't want to spend more initially because you're like, oh, we're good to go. Your payment's going to change. Now, the good part about the program itself and how you get qualified is you still have to qualify for the par interest rate. So you have that safety net. But as we know, when you have more expendable income, it does make it a little bit easier to spend more money. So you're definitely going to have to watch what your budget is when it comes to that. And easing into those payments is another very positive thing, especially if you know that you have some job changes coming up, or someone in the home that's currently working is going to be working, or also from a VA disability perspective, that if your, let's say, tax benefits take 2 years to kick in, at least you know that you can qualify for the full payment. And then you can kind of ease into all those adjustments as they happen. Now let's talk about some of the cons. And I would say cons, but also the ability to be able to access this program and the reality of that program itself, because a lot of people will call from watching the channel, which thank you so much, is that I'm getting this interest rate. Can you beat it? Or, hey, this is my interest rate. What do you think? And I'm like, initially spidey senses go off, or I'm like, man, that's an extremely low interest rate. And when the person explains the yeah, I'm getting this interest rate. This is what it is. And then we're like, well, let's look at the documents. We look at them and they're like, did you know it's this program? And they're like, no, I wasn't aware of it because it's a selling tactic. And I'm going to break that down. So the big con of this program is that it costs money, just like anything in life. But the way that it's paid is what makes it very different than other loan programs that exist out there, okay? So who pays for it? Typically, it will be the seller or the buyer that does that. Now, you got to be thinking to yourself, when you look at some of the average home prices of properties, and let's say someone's got to pay $15,000 to do one of these 3-2-1 buy downs, and the reason why it gets really expensive is because someone prepays the interest for you to be able to get that interest rate. So basically, the builder or the seller is paying the lending institution that X amount of money of interest, the difference, while you're getting into that payment, which, a couple things that go into that. If it's that expensive to buy down the interest rate, why wouldn't they just give you a lower purchase price and not offer that lower initial interest rate? And you really have to think about doing the math on, hey, if my par rate, which is right, hey, I'm not paying any fees for discount points for that interest rate. Again, it changes by lending institutions. We'll do a whole video on that here soon, talking about par interest rates and what they mean. Because again, it's all lender costs get baked into interest rates, right? How much advertising they do. All of that is going to be factored into what that par rate is going to be. So if you get a par rate, but you get a discount from the purchase price, does that make more sense than trying to do one of these 3-2-1 buy downs? And the positive part with these buy downs is that if you have money, let's say you're doing a 3-2-1, in the second year, you're like, you know what, payments have dropped, rates have dropped, and I want to refinance into getting a lower full, like long-term interest rate. Well, you can do that, and that money that was put into this escrow account to make the payment difference gets applied as a principal reduction. So that would be a win-win. And primarily, I see builders doing these, but again, like, this conversation, are they artificially inflating the prices of the houses so they can give you that money? And does it make sense to do the opposite of that? Now, when it comes to just consumers selling their properties and they're working with buyers, this is definitely an up in the air kind of thing, because why in a competitive market would somebody give you that? That's why we really only see them on new construction, not on existing properties. But it can be a technique, especially if you're in an area that may not be as hot of a market. You're looking to sell your home, you're looking to get out of it, and that is a huge factor for you. Well, then maybe offering a buy down is going to make a lot of sense. And that's why the videos that we do are really for everybody, right? If you're buying, you're selling. Because if you're buying, you need to know how to sell. If you're selling, you might be getting into home ownership with a different property. You got to know the end game all the time, because otherwise you're going to be putting yourself in a very bad financial situation. So overall, I think the concept of the 3-2-1 buy down or the 2-1 buy down is good, especially if you can get it offered. The downside, especially when we're seeing mostly builders offer these, is that why wouldn't you just go into a lower payment? Go into a lower purchase price. A whole separate conversation would be, why not just give all of that money and do a permanent buy down, which I actually be more fan of. But when you're working with new construction companies, I did a whole video on this. Typically, they're not competitive in open markets because they jack up their prices. There's like a whole thing to this. So you really have to be careful with that. But also reaching out and asking us to take a look at what you're going through if you're currently in the process of doing that. More than happy to do it. And in 30 seconds, literally looking at like a loan estimate or a cost breakdown, I'll tell you, yeah, this makes sense, or like, this doesn't. This is the other factors you have to think about, because everyone's financial situation is very different. And that's why we want to be able to at least walk you through that process. I hope you guys got some value out of the video. Please hit that like and subscribe button, and I'll catch you guys soon.